go to Nigeria Central Bank Acting Governor Folasodun Shonubi saying the financial regulator is intervening in the foreign exchange market and will continue to do so in order to moderate the volatility in the FX market. Speaking a short while ago at a press briefing following the monetary policy meeting, the acting governor said the decision to raise lending rate by 25 points to 18.75% was to support previous rate hikes that have helped to moderate inflationary pressure. Let's take a listen to him.
The role of the central bank is to intervene and keep the market at a fairly stable level. We have our views as to what that level is, and as the market continues to oscillate around that level, if there's a need for us to intervene, either by buying or selling, that's the role of the central bank. We will continue. We have started intervening, and we've been doing it for a while, and we will continue to intervene to bring the market to the levels that we believe it should be. Right now, in the short run, these volatile times are expected, but we expect them to moderate sooner rather than later. The nation asked about update on the Naira redesign. When the currency is printed and sent out, it is expected that it will go through a number of cycles, and then over time will become one and then would be replaced. That's what we're doing. We had to put out or re-put out old notes, and as they're coming in, they're being processed and returned to us as not issuable. We're then bringing out and replacing them with the new notes. We believe that we have an optimal level of the currency out there. So more of what's being done is replacement to keep the level rather than just putting out money out there. And that is seen by the fact that the banks, whenever they come to us for notes, we provide it to them. If it wasn't enough, they would be asking us for much more. If it was too much, they'll be dumping that much more on us. So we'll slowly, and over time you will see, have the old notes replaced out of the system with the new notes that will be the norm. And that will be out of practice, not fanfare. You'll just see it slowly morph from old to new. The question from Vanguard was around the charges that the POS operators have announced increases. The model that the central bank runs is that we do not deal directly with the POS operators. We have companies that we license, super agents, and the super agents then have agents, amongst which are the POS operators that have the point of sale devices. We have regulated prices with the super agents, and it's their responsibility to enforce those prices amongst the agents that are working for them. So we have informed and reminded the super agents as to what those charges are, and whenever or wherever we find agents that are responsible for behavior, and not just on charges, but behavior in general, that is not in line with the rules of operation, we actually sanction the super agents because they are the primary entities that we have licensed. So whenever we have such situations, please let us know. We're improving our consumer protection methodology for receiving complaints from the public, either about what the banks are doing or have done, and we'll of course cover any other incidences like the POS charges that you're talking about, and that would help us know what is going on, and we will sanction those that err in that regard. Leadership asked about the digital currency and what's happening to it. We continue to learn, and we continue to tweak, and we continue to change the model. We have over 20 or around 25 million people who are registered and have wallets, but we haven't seen the level of activity that's commensurate with those number of people. So we continue to talk to them. The volumes increase, and we learn with each passing day. We are reviewing the model, And we think soon, definitely before the end of the year, you'll see significant growth and changes because the feedback we've gotten from the public and the marketplace has been distilled. And we're listening to them, and we believe it's going to have an impact on the adoption. And then maybe we'll have less new Naira notes to print. Thank you very much.
Okay, so let's get Mark's first word on this latest development. We bring on Johnson Chukwu, who's a market professional and a group CEO at Curry Asset Management. Good evening. It's good to see you. Thanks for coming through tonight. What do you make of the 25 points rate hike and the lowering of the asymmetric corridor to plus 100 and minus 300 points?
Thank you, Bossy, for having me. The key thing that this narrowing in the asymmetric corridor is that it's basically supposed to stimulate the banks to lend money, to place money with the central bank instead of lending. It's actually supposed to discourage lending as it is, because previously, when they had an asymmetric corridor of plus 100 basis points minus 700 basis points was implied that for any money that the bank was supposed to lend or place with the central bank, they were going to take 700 basis points below the MPR rate. Today, MPR rate is 18.75%. So a minus 300 basis points means that banks can actually place money with the central bank at 15.75%. The only constraint that the bank cannot place more than 2 billion naira a day with the central bank. So the maximum amount a bank can place with the central bank is only 2 billion naira. And that barrier, that constraining factor, will actually be the reason, compelling reason why the banks may not be encouraged to go bullish on mobilizing deposits and sterilizing deposits.
Well, as far as the headline interest rate was concerned, 25 basis points, was that in line with your expectations? The consensus by Bloomberg was that it's going to be much higher than that.
One moment.
Hello, Johnson? Okay, I guess we lost Johnson there momentarily. Johnson, I was asking about the 25 basis point interest rate hike that the central bank did today. That was much a bit smaller than the expectations from the economists. Johnson Chukwu, the group CEO at Curry Asset Management. Johnson, my last question, my other question was that the 25 basis point hike, was that in line with expectations, or you were expecting something much bigger?
Okay, boss, maybe I need to change the network.
Yeah, we can hear you. Please go ahead. I can hear you very clearly. Please go ahead, Johnson. Okay, I guess we lost Johnson Chukwu, the market professional and the group CEO at Curry Asset Management. We'll go to that conversation just in a short while. Today, the International Monetary Fund says a raft of interest rate hikes by central banks around the world in their fight against inflation is putting global economic activity under pressure. The IMF today released its latest World Economic Outlook, forecasting a modest rise in 2023 full-year growth, but below historical standards. Let's take an excerpt from the report presentation held a few hours ago by the IMF chief economist, Pierre-Olivier Gorinchas.
The global economy continues to gradually recover from the pandemic and Russia's invasion of Ukraine, but it is not yet out of the woods. The COVID-19 health crisis is officially over. Supply chain disruptions have returned to pre-pandemic levels. Economic activity in the first quarter of the year proved resilient, and labor markets are quite tight in many places. Energy and food prices have come down faster than expected from their war-induced peaks. And financial instability following the March banking turmoil remains contained thanks to forceful actions by the US and Swiss authorities. Under our baseline forecast, growth will slow down slightly less than projected from 3.5% last year to 3% this year, a 0.2 percentage point upward revision for 2023. The slowdown is especially concentrated in advanced economies, where growth will fall from 2.7% last year to 1.5% this year. By contrast, growth in emerging markets and developing economies will remain stable at 4% this year and 4.1% next year. Now, this masks significant differences between countries and regions, with emerging and developing Asia growing strongly at 5.3% this year, while many commodity producers will suffer from a decline in export revenues. At the same time, global inflation is projected to decline slightly faster than projected in April, from 8.7% last year to 6.8% this year, a 0.2 percentage point downward revision. Now, stronger growth and lower inflation than expected are welcome news, suggesting the global economy is headed in the right direction. Yet growth remains low by historical standards, and while some adverse risks have moderated, the balance remains tilted to the downside, and it is too early to celebrate. There are growing signs that global activity is losing momentum. The global tightening of monetary policy has brought interest rates into contractionary territory. This has started to weigh down on activity, slowing the growth of credit to the non-financial sector, increasing households and firms' interest payments, and putting pressure on real estate markets. In the US, excess savings from the pandemic-related transfers, which helped households weather the cost of living crisis, are all but depleted. In China, the recovery following the reopening of its economy shows signs of losing steam, while there are continued concerns about the property sector. Second, core inflation, which excludes energy and food prices, remains well above central bank targets and is expected to decline only gradually. In advanced economies, core inflation is expected to remain unchanged at 5.1% this year, before declining to 3.1% in 2024. Clearly, the battle against inflation is not yet won. Key to inflation's persistence will be labor market developments and wage profit dynamics. Despite tight labor markets, overall wage inflation has increased, but remains behind price inflation in most countries. The reason is simple and has little to do with so-called greedflation. Prices adjust upwards faster than wages when nominal demand far exceeds what the economy can produce. As a result, real wages have declined. If labor markets remain strong, we should expect and welcome real wages recovering lost ground. Indeed, the gap between nominal wage growth and price inflation has started to close. Because firms' profit margins have grown robustly in the last 2 years, we remain confident that there is room to accommodate the rebound in real wages without triggering a wage price spiral. With inflation expectations well anchored in major economies and the economy slowing, market pressures should help contain the pass-through from labor costs to prices. Now, despite monetary policy tightening and the slowdown in bank lending, financial conditions have eased since the banking stress in March. Equity market valuations surged and the dollar depreciated further, driven by market expectations of a more benign path for US interest rates and stronger risk appetite. This provided some relief to emerging and developing countries.
All right, that's the latest from the International Monetary Fund for its second half of the year review of about the state of the world economy. Let's put it out. Inflation still a very major concern. As far as central banks around the world raising interest rates, the outlook is that the U.S. Fed will raise rates by at least 25 basis points tomorrow, Wednesday, the 26th of July. Let's get back to Johnson Chukwu, who's the group CEO at Carry Asset Management, as well as a market professional. Thank you so much, Johnson Chukwu. Have you back. We're talking about the 25 basis point hike by the central bank. Was that too small for your expectations?
No, it wasn't too small for my expectation. And if you even look at the votes, 6 persons voted to increase the rate by 25 basis points. 5 voted to hold the rate at current levels, and only 2 voted to increase at 50 basis points. You see, the reality is that the MPR rate is no longer a reflection of the market interest rate, and neither is it a reflection of real return on investment. Of course, we know inflation rate from the MBS came at a print of 22.79%, which is still above the 18.75%. But the most critical factor is that the drag-along effect that you should expect that the monetary policy rate to have on interest rate within the environment is no longer the case. Today, you are seeing T-bills, 364-day bills, which should mirror inflation rates, which MPR should actually drag along at about 5.9%, 5.94%, less than 6%. That's the 364-day bills. We've seen a consistent decline in Treasury bills yield. And if you look at the bonds, the bond yields are the maximum we saw of the longest tenured federal government bond is in the region of 14%. So this increase in MPR will not have any effect on lending rate, neither will it have any effect on deposit rate. The only thing that could have had effect on deposit rate is the reduction in the asymmetric corridor from minus 700 basis points to minus 300 basis points, which means bank can actually lend to central bank at now at 15.75%. But the limiting factor, which I mentioned earlier, that you really can lend more than 3 billion in a day, also makes it actually not attractive, because when you generate deposits, you first have to take out a 2.5% as cash reserve ratio, which the central bank has to sterilize at no benefit to you. Then they will only pay you 2%, 15.75% on only 2 billion. So the excess of it, you have to sit with you. So what would drive interest rate is the level of liquidity. And we know we have excess liquidity in the system today.
Oh, interesting. So how will the market trade these decisions from tomorrow? What's going to change?
I don't think much will change in terms of the expectations of market operators or direction of investment flow in the market. We saw a 1.1% appreciation in the equities today. I think that trend is likely going to continue. Interestingly, the announcement we've seen so far from the likes of First Bank actually look too mouth-watering, that investors will hope that the other financial institutions, other counters will replicate that kind of performance. So we expect more liquidity to go into the equities market. As it relates to the fixed income market, I don't think the drag-along effect of this increase of 25 basis points will have any effect on deposit rates. It's only when you have return on fixed income instrument, particularly federal government debt instrument, like I did mention, Treasury bills, 364-day bills at 5.94%, about 50-year maturities at about 14.1%. So those ones are the signpost of what will drive fixed income yield. And as long as that is not going up, people will continue to vote on equities.
Okay, so a part of the statement in the Q&A after the press briefing, the acting central bank governor says that the central bank has been intervening in the FX market and will continue to do so to moderate the volatility in the exchange rate. How do you respond to that statement?
Yeah, Boston, that's a statement of fact. That's a factual statement. And I think I mentioned in one of our programs with you that the central bank remains the market maker. Central bank receives about 90 to 95% of foreign exchange earnings. The structure of our export earnings has not changed. We still don't have other products being exported and any foreign exchange. So as long as central bank remains the major market recipient, the major recipient of foreign exchange earnings, central bank will remain the critical market maker. It's the one that supplies the market. So if you see a volume of trade, central bank has more than 90% of a daily volume of supply coming to that market. So it's a fact they've been intervening in the market, and they will continue to intervene until the economy is significantly diversified, which is not a short-term expectation.
Interesting. How much confidence do you think today's central bank decisions and statements will inspire foreign investors in the market coming to Nigeria, putting in whether portfolio or direct investment? Do you think this is what they've been waiting for?
What they actually been waiting for two things. One, have we gained liquidity in the FX market? We are yet to gain liquidity in the FX market. Do we have stability in the exchange rate? We are yet to have stability in the exchange rate. Local currency, local currency instrument earning yields, returns above inflation rate. The answer is still no. We still have negative real interest return. So, and again, instruments in the local market are the treasury bills, short-dated instrument, the treasury bills, long-dated instrument, the bonds. They are all trading at yields materially below the MPR rate. So, like I said, there is a disconnect between the MPR rate and the market rates obtainable in the economy today. As long as that disconnect remains, and they are not getting yields of the region of 18%, 16%, 19% from those short-dated instruments, they are not likely going to come into the market now.
So what signaling of rate direction in September and December did you get from today's briefing? Where do you think the central bank will go next?
Well, if you look at the near tie between those who wanted to hold and those who voted to increase by only 25 basis points, there is a very likelihood that come September meeting, the decision of the committee will likely be to hold, or most likely to hold if current macroeconomic environment still subsists. But of course, macroeconomic environment can be very dynamic. The decision will be determined by what is obtainable in the environment at that point, what is inflation rate, what is the pressure on exchange rate, we have stability in exchange rate, what is the level of productive activity in terms of the GDP performance. By that time, I would have had the second quarter GDP performance results. So these are factors they have to take into cognizance in taking the decision at that point.
All right, thank you so much for those words on the Central Bank of Nigeria's rate decisions. Thank you so much, Johnson Chukwu Group CEO at Cowrie Asset Management here in Lagos.